right away at the word go. So GIFT Nifty was indicating a flattish start. I think the pre-open indicated a slightly flat to higher start, and you're getting about a 50-60 point dip, continuing from the 0.25% loss that we saw on Friday. All right, the Bank Nifty is up on your screen. We're at 46,666. And you've got the mid-cap index, which is also starting just about 0.18% lower. But Sonia is standing by on the wall with more rates. Sonia.
Thanks a lot for that. So since the market is very flat, right? I mean, there's a bit of a negative bias that you're seeing at the moment. But let's look at what individual stocks are doing. Reliance is the one that is top of mind as reports that the merger pact with Disney has been signed now. Reliance is flat with a bit of a negative bias. Asian Paints have seen a lot of brokerage downgrades, as Mangalam was just telling us a while back. Asian Paints has seen a further slide of 3.5%. CLSA has downgraded Asian Paints to a sell. They have cut their target price to 24.25, which is a big downside even after the recent fall that Asian Paints is seeing. And their primary concern is the fact that Grasim entering into this space will make it very uncomfortable for the current incumbents. Kotak Mahindra Bank in focus. Kotak Bank will be selling 70% of Kotak General to Zurich Insurance Company, so keep that on your radar. Banks in general have been under a little bit of pressure in the last 3 days. HDFC Bank is flat. RBI has approved a stake sale in HDFC Credila. I'm looking at SBI Card as well because that one could be under pressure. It's been losing market share, down about 0.5%. The market share has fallen to 18.7% versus 19.6% year on year. JSW Infra is actually looking good. It's awarded, it's won an award for handling dry bulk cargo. So keep an eye out on that. Zen Technologies is in focus as well. It signed a contract for mobile phone manufacturing. It's putting up a new plant in Uttarakhand as well. So that stock is looking good at 6,900. Apart from that, Paytm up 4.5%. So clearly one of the big stocks of the moment. The RBI has advised the National Payment Corporation of India to be the third-party application provider for the UPI channel. So Paytm is up about 4.5%. And, a couple of other stocks. Asian Paints, of course, is the big loser. But you also have other large caps like Titan, BPCL, the entire technology space, HCL Tech, Tech Mahindra are all under pressure right now, down about 0.5% to 1%. So that's taken the Nifty down about 50 odd points, but nothing alarming, just a flat move with a bit of a negative bias. It's the Nifty Bank that has been struggling for the past few days, and that's something that continues. Back to you.
All right, thanks a lot for that, Sonia. Well, a couple of big stocks that are moving around. You have Vodafone Idea as well as Indus Stars. There is that hope that Vodafone Idea can come up with the money, and that's why after seeing the big run that we saw in Friday's trading session, there is some green on both those two stocks. Jio Financial Services, what a beautiful move we have seen on that stock. One of the big outperformers for the month of February as well as for the year so far. It continues to chug along. It's moved from around 240 to around 340 in record time, I think in the last 45 days or so. Couple of stocks are in focus because they've won orders. You have transformers and rectifiers. A small order win is what we were flashing for on the screen. So that stock had opened up briefly in the green. Skipper, they won yet another order. I think this time it was from Power Grid. So that stock is well as high. So both those two reacting to that piece of news. Sonal told us that Rain Industries, well, the past quarter wasn't great in terms of numbers. The outlook, though, their commentary was quite positive. For the time being, though, it's under pressure. It's down 7.5%. IRIDA made a high of around 215 rupees a few days ago. Well, that's come off the top, and now it's hovering around 151. There's no exit today. It's at lower circuit. And two stocks in the broader markets that are moving on particularly high volumes. One is Infibeam as well as Tourism Finance, where we've seen quite a lot of block trades out there. So both those two in top trading stocks, just pointing both of them up, Infibeam and Tourism Finance.
All right. Well, 45 points lower is what we have on the Nifty, and things are looking, a little off, but off color, I should say, but nothing large at all. Market breadth is strong. There's 2:1 in favor of advances. So again, I mean, in the broader market, things are looking good. Geo Finance is the top volume traded gainer. Geo Finance had a good week, the last one. It went from, I think, about 270 from the week prior close to 340 as of the close last week, and it's trading around there this morning. Paytm is up another 4%. I think we mentioned that, big volumes. I was talking about Vodafone Idea earlier, and that's the one, along with the Indus Tower, which are looking up. JSW Infra, I think we mentioned. Tourism Finance, Nigel just pointed out. Idea Forge, right? That's the other one. There was that news that Idea Forge is going to start sort of get into the US markets, right? 6% higher on Idea Forge. So it's come off a big trough. The low recently was about 686. Stocks 800 plus now, Idea Forge. But of course, nowhere near from where they came to the market. Zaggle is another one which is moving up. Zaggle has had a pretty good run. And the stock now is is done phenomenally well, 30% in this month so far. Indocount, I don't know if it's just one textile name, but Indocount is up 4%. PNB Housing is up about 4.75%. That's it's about 735 or so. And look at something like Orchid Pharma, 7.5% higher, and it's got volumes on it as well. You know, another one we highlighted on Friday and Thursday as well was Tarmat. Tarmat is up another 10% this morning, and it's got decent-sized volumes coming through right now. And there is Voltamp as well, which is up about 5%. So lots of movers and strong out of the gates is how you describe, you know, the market action at this point in time. The only big noticeable loser is Rain Industries, which is down 7%. I mean, of course, it's had a very sharp run up. So that is that. And of course, we already highlighted Asian Paints, a lot of cautious commentary. So the stock's taking a bit of a break. It's down 3.5%. Pratik Gupta is with us, Chief Executive Officer and co-head at Kotak Institutional Equities. Pratik, it's always a pleasure having you with us here. Good morning. Thanks very much. Prashant this side. You know, we had a bit of a break with these stake sales. Large investors, private equity, VCs, promoters. But, well, that's back. Back and how? And last week was big. The week before that was big. What's going on, Pratik? And, you know, we are, just to differentiate this, a lot of MNC promoters are also selling, right? Which is it's picked up quite a bit. I think it started with Timken, but we've had 2 or 3 more transactions since. Your thoughts?
Hi, good morning, Prashant. Thank you for having me here. Yes, you're right. We've seen we will probably see more of these stake sales coming through. Typically, what happens is during the earnings period, which is usually, you know, the 15th of Jan to 15th of Feb, typically, a lot of the sellers are insiders. These are either promoters or private equity funds with board seats. So they typically don't sell at that point in time. Also, investors are quite distracted with you know, looking at their own portfolio companies with the earnings season going on. So typically what happens is after the earnings season every quarter, you do tend to see a resumption of stake sales coming through. So this quarter is no major surprise as such. On the MNCs selling their stakes, I think it's very company specific. For example, both in the case of Whirlpool, BAT, etc. It's also a little bit to do with the issues at the parent. The local unit is trading at much higher valuations, so opportunity to monetize, and the market is buoyant, so that kind of supply can get absorbed. So those are the kind of issues over there. But generally, yes, we are seeing more stake sales come through. And that in some ways it adds more liquidity to these stocks, which they may have a lower free float, so that helps in terms of overall liquidity. But I think from investors' perspective, longer term, they need to look at the fundamentals of the company and not get too hassled by these stake sales by promoters. They may have very different intentions and very different time horizons versus investors who are buying the stocks over here.
Okay, interesting. Well, Pratik, hi, good morning, and thanks a lot for joining in. So let's talk about where there is potential in this market, right? Because that's the one thing that everyone is struggling with, to find growth as well as value. It's just become such a tough market to find good valuations. Where do you see potential now over the next 1 to 2 years?
So you're right. I think most investors are struggling on the valuations where they are right now. India's Nifty at 22,200 is currently trading at 20.5 times 1 year forward earnings, which is not cheap by any stretch of the imagination either, versus India's own trading history, whether you take a 5-year period, 10-year period, 15-year period, or when you compare with the likely growth ahead, we think growth is slowing down. FY24 at Kotak, we are expecting the Nifty to grow earnings by about roughly 18-19%. But we think over the next 2 years, the growth will slow down to about 12% on average. Again, if you put yourself in the shoes of a global investor, again, India looks quite expensive compared to, say, a China, some of the other Southeast Asian markets. Now, granted that in China, there are policy risks and there's greater uncertainty, but nonetheless, the valuation gap and the price performance has been very stark in the case of India. So we are seeing a lot of global investors struggling with buying stocks in India. In fact, they're just holding on to what they have. We're not seeing too much of fresh inflow. That's also reflected in the year-to-date foreign selling data on the cash market. They've been net sellers to the tune of roughly 50,000 crores from 1st Jan till last Friday. And the local funds, they are seeing inflows, therefore they're investing. But even they, when we speak to them, are really struggling with the valuations right now. And it's more of a, I guess, just being a bit more opportunistic here and there. But if just to go back to your question, the areas where we think there is still some value left is perhaps still the banks, which have done well, but not as well as the broader market. Banks and insurance companies are still trading below their pre-COVID valuations 4 years back. So we think that's one area, that's the only major area which stands out. Then obviously there are other areas like, real estate or high-end consumption in the form of luxury hotel chains and so on. But amongst the large sectors, I would say it's only the banks and maybe the life insurance companies.
Right. Hi, Prateek. Morning. Good to see you in. Nigel on this side. Within banks, what would you like at this juncture? Private sector banks or public sector banks? Both of them have moved in opposite directions, actually. So at current reckoning, what do you like? And also, you had a conference, right, last week. What are the key takeaways? Couple of points.
Okay, first on the banks, we continue to like the large top 2 or 3 state-owned banks. The main benefit over there being, despite the strong price performance, valuations are still attractive. But keep in mind that we're running in a very tight liquidity situation. Deposit growth is tough. The state-owned banks have a very strong deposit franchise, and that enables them to garner deposits quickly to meet the credit growth requirements. So we like the top 2, 3 PSU banks, but equally, we still like the 3 or 4 top private banks. Although I must highlight that in the short term, given the ongoing tight liquidity situation, we do expect to see slightly weaker earnings growth for the bank sector as a whole in the March quarter and the June quarter in the short term, because loan growth is slowing down, NIMs are coming under pressure, and the best of the low credit cost period is behind us. So from now on, credit costs will only inch up slightly. It's just that the overall valuation versus the rest of the market still looks relatively attractive compared to other stocks in other sectors where either the stocks have gone up quite a bit and valuations are getting looking quite expensive. Now, coming to your question about the conference, yes, we had a very large turnout at our annual investor conference last week in Mumbai. We had 1,000+ institutional investors. And I think more interesting was this time the increase came more from the foreign institutional investors. We had, if I remember correctly, roughly 250 institutional investors from all over, from New York, London, Singapore, Hong Kong, etc. And many of them came with large teams. Some of the large global long-onlys came with large 18, 20-member teams. And we had a very wide variety, from sovereign wealth funds to long-onlys to boutique India-dedicated FIIs to hedge funds and so on. But I think one overwhelming message that we came through, which ties in with what I just said earlier, there is a lot of interest in India. Everybody is trying to come up to speed and improve the knowledge about various sectors and stocks in India. Many of them were coming for the first time or coming after many years. But there is not an inclination to buy India right away. Almost everyone likes the medium-term story, but they find valuations a bit challenging.
Okay, all right. Just one final word from your end on some of these spaces that have been doing pretty well in the last 6 to 12 months, right? Whether it is the electric vehicle space, the renewable energy space, defense PSUs have been doing very well. Any of these themes that you still like, where there could be follow-on buying despite valuation discomfort?
So I think in the renewable energy space, yes, that's a growth area. So all of these spaces actually, fundamentally, we like these. These are long-term sort of growth stories. But I think it's also you have to go back and look at them literally stock by stock. In some cases, let's say the PSU defense companies, we are a bit cautious in the short term, despite a very positive long-term view. So it depends on the investment time horizon. In the next 2, 3, 4 months, we would be a bit cautious. Perhaps if these stocks stagnate or correct a little bit, we may become a bit more positive. Although from a longer term perspective, 3 to 5 year view, we're still very positive. EVs, I think there could be a little bit of a slowdown in the short term, government subsidies being withdrawn, more competition coming in, the incumbents coming back with their own models and launches and, getting new technology, etc. But again, it depends on the company, which sector, two-wheelers versus two-wheelers, we're relatively, EV two-wheelers, we would be more positive compared to the others. And so on. So it's really stock by stock. But in general, I would also look at the incumbents in these spaces where you would be a little bit more cautious.
Okay, all right. Thanks a lot for joining in, Pratik. Appreciate your thoughts here on CNBC-TV18. Well, that's the word coming in on the market, which, by the way, is very, very quiet. It's not done anything up until now. Absolutely flat. The Nifty just holding on to record highs at 22,100. And individual stocks, Asian Paints is actually your biggest loser this morning. On expected lines, I guess, down about 3.5% now in Asian Paints. That big CLSA downgrade has come through. But on the flip side, L&T, Bajaj Auto, Power Grid, Cipla are a couple of stocks that are doing pretty well. But let's take it straight to Aarti Industries. The company's Q3 performance has been weak year on year, but it was another quarter of sequential growth. Rajendra Gogri, the chairman and managing director at the company, joins us now to talk about that. Mr. Gogri, good morning. Always great speaking with you. Thank you for joining us on the show. I wanted to understand how the demand situation is currently, because you had mentioned that in certain segments like dyes, pigments, polymers, there is some recovery in demand, but the quarter has been very weak for you. So just tell us about the situation on the ground currently, and if you're seeing recovery, what kind of growth are we looking at in Q4 and FY25?
Yeah, as mentioned earlier, that inventory correction and all is going on sequentially. So our Q3 performance was better. So discretionary side, I think sequentially demand is getting better, and so Q4 will be better than Q3. And FY25 for discretionary should be near normal. But agrochemical, I think product-specific pain may remain carry forward in FY25 also. As far as the demand is concerned.
No, so can you give me some numbers? In the 9 months of this year, the revenues were down about 7%. You're sitting on a base of around 500 crores for 9 months of this year. Do you see further pressure before things recover? And what is do you see single-digit growth in FY25? Any kind of estimates?
Yeah, this first 9 months we had about 700 crore plus EBITDA, and this year FY24 we are targeting about 950 to 1,000. But next year we expect almost 50% jump in EBITDA. So EBITDA target about 1,450 to 1,700 crores next year, based on both the volume growth as well as some margin growth as the normal market demand recovers. So substantial increase is expected in next year, FY25.
Okay. So basically about a 40% growth in EBITDA, right? In FY25 over FY at the lower end, but it could be higher if you do 1,700 crores
Yes.
in FY25, 20-25% volume growth. Mr. Gogri, so is the worst behind? I think from a investor standpoint, that's the big question. At what point have things troughed as you see it? What's going to be? Just talk to us about that, because we have the numbers, and is it going to be a sort of tactical kind of a recovery, and again you see a bit of a slump, or have you seen the worst and now for the next couple of years things are going to be up? You said discretionary demand should be back to normal next year. Go on, sir.
Yeah, I think as far as the discretionary demand next year should become normal. So worst is over, and I think agro also, I think after a couple of quarters we should get a normal demand. And as we have been putting up more capacities, for us, definitely this year will be the launch pad for multi-year growth. So like next year we're expecting 40% plus. And subsequently also we expect a sizable growth coming in with a new product range.
So agrichem should also normalize, say in FY20, but only maybe a year out, sometime early FY26?
No, FY25 general indication is by a couple of quarters, I think it should normalize. That is a normal indication from all agchem companies. So second half of FY25 should be near normal for agchem also.
Got it. All right. Hi, Mr. Gogri. Morning, and good to see you win. So that 950 to 1,000 crores and around 1,500 to 1,700 crores in terms of EBITDA. But the sense I get is you're bracing for better times going ahead. And I say that because of your capex plans. For this year, I think capex plan was around 1,200 crores. You could correct me on that number. And for the next 2 years, I think you have a capex plan of around 2,500 to 3,000 crores. Could you give us, outline this capex plan? And what is your debt number and what does it go to at peak levels?
Yeah, FY24 around 1,200 to 1,300 crore, and FY24 and FY25 combined is 2,500 to 3,000 crores. And as far as debt is concerned, we had about 2,900 crore debt currently, and some debt increase will happen in FY25.
So what is the peak level, sir? 2,900 is the net debt in the books?
Yes. Next year, around 3,700, 3,800 kind of a debt in FY25 may happen.
So, and the debt peaks out at around these levels, I'm guessing.
Yeah.
And on this capex that you're talking about of, close to 2,500, 3,000 crores for the next 2 years, could you give us what it could be the asset turn on that?
Yeah, this our new products. What line we are adding is more on more value-added products. So asset turn will be around 1.2 on that.
Okay. So you're saying next year in FY25, your debt will be 3,800 crores and your FY25 EBITDA, you're looking at 1,450 to 1,700 crores, correct?
Yes.
Okay, got it. Can you tell us how chemical prices are panning out at the moment? Is there an increase that you've seen in benzene and toluene prices? And what is the expectation over the next 6 to 12 months?
Yeah, current quarter, the benzene toluene prices have seen increase, and actually that tends to more with mirror with the crude oil also. So we cannot have any forecast over 6 to 12 months. We generally follow crude oil prices.
Okay. And can you tell us what is the update as far as long-term contracts are concerned? Most of your long-term contracts have not seen the revenues materializing substantially, but when will it start contributing to your own revenues?
Yeah, this last contract what we have announced is already running on a full stream, 1,500 crore per year. And the 3,000 crore also already is a running contract. And that also the volumes will be continuing from that.
Okay. All right, Mr. Gogri, we'll leave it there, sir. And good to hear that you're saying that the, in your own words, worst is over. Discretionary demand should be good, 40% growth in EBITDA, and FY25 and AgChem should also do well starting in a couple of quarters. So basically second half of FY25 when that should start to sort of come in as well. Thank you very much for joining us. That's Aarti Industries, 672 is where the stock is at. Well, the market's down 40 points, so it's quiet. Market breadth is still positive, although I think the gap has narrowed down a fair bit. Hoodco has come up with a 6% gain. I mean, that's a new one, which is looking good. And, I can spot a few of these Adani Group stocks, which were not there in the mix in the morning. So there is Adani Total Gas, which is up 4%. And Adani Energy Solutions is the other one. That is basically Adani Transmission, which is up 4% as well. So, both have got large volumes as well, which should be up on your screen. Yep, there you go. And of course, I mentioned Idea Forge earlier. It continues to do well with the 8% pop at this point in time. Policy Bazaar is another one. High interest stocks, so just mentioning it. It started quiet, but it's up 4% now. So that's another one to take note of. On the downside, I mean, there is only, there was Rain, which was down sharply. Asian Paints was down sharply. And there may be a few more which have joined. Tata Technologies is down 4%. And there is Phoenix Limited, which is coming up with a 3.5% cut as well. So these are some of the volume-led large losers at this point. We'll take a quick commercial break here. We'll come back. And of course, we'll get chatting with Mr. R.K. Goel, Managing Director at Kalyani Steels, to discuss their MOU with the Odisha government and of course business plans and business outlook going forward. Stay tuned.
Welcome back. Well, let's focus on the stock that's been in focus for the last 3 months or so. Kalyani Steel. They've signed an MOU with the Odisha government to set up manufacturing unit with a total investment of around 11,000 crore rupees. Mr. R.K. Goel, the managing director at Kalyani Steel, joins us on the show. Hi, Mr. Goel. Good morning, first of all, and thank you so much for joining in. You know, Mr. Goel, for the last 10 years or so, whenever you have joined at the channel, I've kept telling you that the promoter entity is lacking that fire. And the street really, is always disappointed that you have cash, but you're not expanding capacity. Now you have come back in style. We have seen inorganic growth, and you're talking about a massive capex in Odisha. Just to clarify a couple of points, 11,000 crores plus, right? 11,750 crores is the total investment that you're putting in. Could you confirm that? And also, could you break it up for us? How would you fund it? Will it be a mix of debt, equity? Is the promoter entity looking to infuse some more money into the company?
Good morning. First of all, we were looking at a right opportunity, right environment, political stability to set up a project in the country to make investment. As you know, typically projects in ferrous or non-ferrous segments are highly capital intensive. Today, we are at the right environment, right political stability, and global situation is very helpful for India. So that's why we have taken a decision supported by the Odisha government to make a large investment. Now, the total investment, 11,750 crore, is in two parts. One is for specialty steel and auto cluster. Second is for titanium alloy, titanium metal, and aerospace and defense components. Now, as far as the titanium part is concerned, it's extremely difficult to get a technology. So we are in the process of developing technology, which will take some time. As far as the specialty steel and auto cluster part is concerned, that's our core competence. And this project will move very fast. Even then, starting from environment clearance and all, it will take anyway around 4 years of time.
4 years of time. But sir, the question that I asked was, how do you fund it? So we have got broad details of the entire project. You waited for the right time. It will come up in the next 4 years. You're looking at all clearances. How do you fund this? 11,750 crores. How much of it will be debt? I think the last time you mentioned you have some cash of around 600 crores. So how much of debt, how much of equity, how much of fresh issue, how much does the promoter bring in?
As I mentioned, we divide the whole thing into two parts. First, let's talk about specialty steel and auto cluster. In that, we will be able to fund by equity as well as the debt. And we have already got a lot of offers which are coming up, that there are a lot of people who are ready to lend us money and at a very attractive rate.
Okay, so there'll be an equity component as well. Let's understand more then, sir. Do you want to break it up for us of the ratio of equity and debt? And you're talking about people are interested. People have been very interested in Kalyani Steel because it has good parentage and there's tremendous scope of growth. So in terms of the equity component, will it be from a financial investor? Will it be from a promoter entity? Or could there be a larger steel company that wants to be part of the business?
No, you see, we already have a lot of cash and next 3-4 years of cash generation and all. I think that will take care of whatever the equity component required. And if there is any shortfall, we will find a way to fund it. But I'm pretty confident we may not require. And balance will be debt. And we are yet to fine-tune everything because after signing the MOU, now some of the costs, we have a better clarity. But still, once we start negotiating various equipments and all, then we will know exactly how much is the money required. And accordingly, we will organize. I don't see any problem in that area.
So could you break it up for us? How much will be the equity component? How much are you looking at in terms of the debt component, sir?
It can be anything around 60-65% or something like that.
60-65% will be equity?
No, debt.
Oh, will be debt. All right. Okay, got it. That gives us a little more clarity on the situation. Can you tell us who are the targeted customers that you're looking at? Will it be with the group company Bharat Forge itself?
Actually, this project is configured in a manner that majority of products will be produced which are not produced in the country. And at the same time, they are produced only by 1 or 2 companies globally. So it will be replacing some other products or imports or it will create a large international market. At the same time, this project has a capability to produce 100% green steel. So there are a lot of things which really need to unfold, including CBAM and all. And if terms in CBAM is attractive, we may produce major part of it as green steel and export. So right now we are keeping fingers crossed, but it will have features which nobody has in the country, and hence it has very little to do with the group companies. It will be largely non-group companies.
Okay, so it'll be predominantly for exports?
It depends how the things unfold. If it is the CBAM terms are favorable, then we can start manufacturing green steel and start exporting. And even otherwise, we'll be able to export.
Mr. Goyal, I just want to understand, sorry, we need to come back to this, but it appears like a big development. So as you told Sonia, 60-65% will be debt. Of this 11,750 crores, 60-65% will be debt?
No, let's, as I mentioned earlier, let's talk about the specialty steel and auto cluster first.
Okay.
I'm not talking of the titanium part.
Okay, so the specialty steel, sir, specialty steel is around 6,600 crores. Out of that,
it is not only specialty steel. Sorry, it is with the auto cluster.
Yes, with auto cluster, sir. That entire thing is estimated at 6,600 crores, and the graphics will come up for our viewers on the screen as well. Out of that, 60-65% will be via debt, right? So you still have that, remaining around 2,500 to 3,000 crores. Now, that amount will be entirely equity, or some portion of that will be cash as well?
No, there are several things. One is for the auto cluster, there will be some other entities within group, without outside group, they'll be ready to invest. Number two, there will be certain other benefits which will be available, right? For the auto cluster and all. So I think with next 4 years of profits and the current cash available, we will have adequate funds available for setting up our portion of the project.
Okay, no, but the reason I ask you is your market cap now is around 3,500 crores. Even if you raise, even if you raise 1,000 crores via the equity route, it will be a big dilution.
No, we have not really worked out, and I don't think we are thinking in that direction. We are not thinking in that direction.
You're not thinking. So the equity component could be how much, sir?
We are still working out, as I mentioned, roughly indication I have told you, and we will find a way to fund it.
I think in the next couple of months, then it'll be interesting to see developments because on Kalyani Steel as well as on this, capex will require further details. But I think one thing that you can tell us is on the pricing front for your core business as of now. The last time we chatted, you said 20% had agreed on that price increase of 3,000 rupees per ton. What is the remaining 80%? Have they also come on board for this 3,000 rupee per ton increase?
It is at the final stage of negotiation, and we are very shortly going to close it, and we'll definitely get.
At 3,000 rupees?
It may be 3,000. You see, when you are in negotiation, you can't be very rigid that I'm going to get X amount, Y amount. And it is a negotiation with the industry. It is not with one single company. All right,
Mr. Goyal, you're keeping your cards very close to the chest. The last couple of interviews that we have had, we want to hear more about Kalyani Steel. And even today, me and my fellow anchors, we have tried to get out details with regard to this Odisha plant. You've given us broad details, but I think the next 2-3 months, we'll have to watch it very, very closely to get concrete details. But thanks so much for joining in here on CNBC-TV18.
Okay, thanks a lot for joining in, sir, and all the best. That's Kalyani Steel. But let's move on and talk about Zen Technologies. The company has bagged orders worth 93 crores from the Defense Ministry. To discuss more on this and their business outlook, Ashok Atluri, the Chairman and Managing Director at Zen Tech, is with us. Mr. Atluri, thanks a lot for joining in. If you can just tell us, what is the total amount of orders that you have received from the Ministry of Defense so far? What are you looking at in terms of execution over the next 12 to 18 months? And what are the new orders that you've bagged in this quarter, in Q4 so far?
This year we still, we're hoping that we'll complete the 450 order that we have projected to the shareholders. And next year, again, we are thinking that we will do 900 crores. And at present, the total order book position is about 1,500 crores. And the recent order that we received was for about 93 crores. And this was for a very, very important aspect of training, which is basically tactical training. Most of the orders that we have been getting till now are related to technical training, but not for actual warfare kind of preparation. And this is a big order for us. And we assume that this will scale up significantly as we go into the future.
Okay, so 1500 crore is your order book currently, and you're saying that 450 crores of orders will be completed in this year, and you're targeting 900 crores in the next year. As you said, you know, this space that you're operating in, tactical training, is a very, very niche space. So can you tell us what is the potential that you're seeing here, growth in this space over the next, say, 1 to 2 years? What are we looking at in terms of the opportunity size? And how do you think, you know, are there any gaps that need to be filled from the government's end, etc.? Any challenges that you're facing currently?
Government has been very aggressive in terms of, simulator. As the Chief of Army Staff also has told on multiple occasions that they have started the journey for simulators, and it is just the beginning. So we think a lot of orders will come from them. And they, as you can see, the shift from, technical training, they're going aggressive, they're going more deeper, but they're also covering the tactical training aspect of it. We think that, it's at least a couple of thousand crores worth of opportunity just in India, and abroad it will be probably double of that. So this is a very huge opportunity for us in terms of our simulator complete range.
Okay, so if you're saying that couple of thousand crores worth of opportunity, you said earlier that you're targeting revenues of 1,000 crores in the next 5 years. Given what you've seen so far and the opportunity size, would you want to change that in any way, and any near-term targets that you can share with us? By the end of FY25, where do you see your revenues?
So FY25, it's going to be 900 crores. That's our expectation, and probably a little more than that. And we have said that it will be a CAGR of at least 50% thereafter for 26, 27, and 28.
Okay, all right. Hi, Mr. Atluri. Congratulations on this order win. A couple of quick questions about getting into an election year. How do your payments come in? Is it coming smoothly? Some part of it would be coming from the government of India as well. Any delays?
Nigel, I would like to say that, if anybody is claiming that there are delays in the army from the payment from the army, I would be really surprised, because we are getting our payment just on time before the 45th day, all the payments. If somebody is saying that, I'm getting this question a lot, but, we have never had any issue with payments when we have supplied the right, right item, whatever we have promised, and they have accepted it. So there have been debates during the acceptance that this is what they want. But once they accept and we present the bill is paid by the government within 45 days.
Okay, so that's good to hear. That's a niggling worry, right? Getting into elections, but you're clearing the air. There's no delay. Before the 45th day, the money is coming to Zen Technologies, so your investors will be rather happy. The other question I had is, since you're saying there's such a huge scope, big potential out there, and the biggest problem for the company was the order book. Now that is ramping up, and that's why that's giving visibility. There could be larger players here in India as well as overseas that would like to partner with Zen Technologies. Have you received any kind of offers that you have 55% stake in the company to dilute some equity, also be part of the company, maybe pump in some money? Have you received any offers?
No, we have not received any offers like that, and we definitely would like to partner where we don't have the capabilities and the foreign companies have the capabilities, or any other partner has the capability. We definitely would like to partner with them, as long as the end user, the Indian Armed Forces, benefit from it. So yes, we are exploring various options, but there is nothing close to any deal as of now.
Okay, and you'll be okay to dilute some equity?
Yeah, absolutely. I mean, it's on the larger interest for the country, you would do anything. Yeah.
Okay, all right. Can you tell us what could the R&D spends be over the next few years? What are we looking at?
So we have been spending about 15 to 20 crores last few years, and we expect that, it probably will go to about 30 to 40 crores as we go and expand our R&D scope. And, as we keep more acquisitions coming in, on Saturday, we announced another acquisition of a company called AI Turing. They are in the business of, electronic optics. They make cameras, and there was the only camera accepted by us in our portfolio of the anti-drone system. Anti-drone system typically consists of a jammer, detector, radar, and a camera. Camera we were trying to buy off the shelf, but we were very disappointed. There were a lot of claimants, but no deliverers. So this was the only company that delivered. And, when we said we would like to partner, they were very happy. So we acquired 51% of the company, and this company is into electronic optics and robotics. So we are very excited about this acquisition.
So any more acquisitions that you're looking at in the near future?
We are absolutely. I mean, we have taken a huge, pre-approval from our board, and shareholders. So we think that there are going to be some acquisition in the next 12 to 18 months space.
Okay, and that would be in the same field, in the same space itself?
Yeah, absolutely. I mean, most probably will be in electronic warfare or anti-drone and simulation systems. Yeah, these are the two things which we are in. Yeah.
Okay, all right. We'll let you go on that note. Thanks a lot for joining in. By the way, the market is under a bit of pressure now. The mid-cap index is down about 300 points. The Bank Nifty is down 120 points. Not looking that great. The Nifty is holding on to 22,100, but by the skin of its teeth. Mitesh Thakkar is joining in now to tell us what to do. Mitesh, little bit of choppiness is coming into the markets now, led largely by some of these technology names. So Tech Mahindra, Wipro, TCS are all your top losers this morning. And of course, Asian Paints, which is down 4%. Any thoughts on how to approach it for the rest of the day?
So I think, we talked about this, that the market is now showing signs of consolidation. The key area for me on the Nifty is about 22,050. So another 40 or 50 points lower, I would want to see if a buy trade can be initiated. And then, keep a stop below 22,050 and maybe look at 22,250 as the first target area. So I think maybe a little bit more of dip, and I think I would want to take a long trade with a tight stop loss. And on the stock side, I have a buy on IRCTC, which I recommend buying with a stop below levels of 965 for targets of 1,025. And also a buy on Granules, which just made a fresh swing high. So Granules is a buy with a stop at 465 for targets of 493.
Got it. Mitesh, I wanted to ask you about the big boy HDFC Bank, because normally that's been the culprit, right? The market goes down means HDFC Bank has slipped. Now it's stabilizing. In fact, it's holding mildly in the green. And from that recent low that we saw, a couple of weeks ago at around, I think, 1,350, 1,370, it bounced back. What are the crucial support levels on HDFC Bank?
So now just two observations. One, I think now it's showing signs of the decline coming to an end, but we don't have signals of an uptrend. So I think it'll be choppy. But as you rightly pointed out, a couple of weeks back, the stock made lows below 1,400. So around that level, 1,380 was the, or 1,385 was the lowest closing we got. I think that's the first important support area. I think around that level, if you get a chance to enter again, take a 25, 30 point stop loss and go long. Though it may not give you a big trend reversal, but a very strong bounce back given the fact that one, it's oversold, and two, it's now showing signs of decline coming to an end. I think it might just chop around. So that strong bounce back could happen from the previous low, and that could see the stock head towards 1475, 1480 zone. So try to buy below 1400 with a 30 point stop loss, and around 1480 try to take profits. A breakout about 1480 and we'll look at some kind of an up move.
Okay, thanks for that. Well, let's go across to Mangalam now. He's going to tell us about some of the paint companies. Of course, Asian Paints is your big loser, down about 4%, and some brokerage downgrades coming in, Mangalam.
Absolutely, with the kind of competitive intensity that the sector is likely to see after especially the launch announcement of Birla Opus, brokerages are a little circumspect on the multiples that paint companies are trading at. Case in point, the industry leader itself. So we have CLSA, which has downgraded Asian Paints to sell with a target price cut from 3,200 rupees to 2,425, which is actually the lowest target price on the street. They believe that because of the higher competitive intensity, there is case for the company's multiples to move back to its 15-year average. So currently, as per them, stocks trading at 66 times. They believe that it's likely to trade at around 43 times, and that is more like it. And Goldman Sachs also believes that, because they've lowered their target multiple from 58 times to 52 times, and they've cut their EPS estimates as well. They believe that the Birla Paint strategy is a lot more comprehensive than earlier assumed. We also have Macquarie's note coming in on the paint sector, where they believe that even though discounting levels may not rise, companies like Berger may be impacted by Grasim's entry into the paints foray, even as Asian Paints keeps its leadership. So as a result of which, we are seeing some nervousness in both Asian Paints and Berger.
Okay, some nervousness in Asian Paints and Berger, but Rain Industries is also on our radar. Sonal is here to tell us more about that. Sonal, over to you.
Well, Rain Industries is lower because of a weak set of quarter 4 numbers for calendar year 2023 that the company has reported. Revenues declined 1.5%. There was an EBITDA loss this time around of 613 crore rupees versus EBITDA last quarter of 366 crore rupees. This has resulted in a loss of 1,078 crore rupees versus a loss of 66 crore rupees. This is on a quarter-on-quarter basis. Now, there are two reasons for losses to be so much higher. One, the tax has increased to 995 crore rupees versus 462 crore rupees. And second, the company has taken an impairment loss, and it's a big one, one. It is around 751 crore rupees in Q4. But if we strip that as well, it will be a higher loss on a sequential basis. The company goes on to say that there are two segments. First one, which is the carbon segment, which was impacted due to delayed shipments and also margin contraction. The second one is advanced materials, which was impacted because of seasonal factors. So these two did not do well. However, the cement business did well because of better volumes and realizations. But yes, it's a top-down miss, and that's why a sharp knock on the stock today.
All right. Sonal, thanks very much for that. That's Rain with the sharp knock, as Sonal points out. We'll take a quick commercial break here. We'll come back, and Manisha joins in, as always, to put the focus on commodity markets. Stay with us.
Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at the metals as a sector, and last week was a positive one, but an outperformance clearly came in from nickel as a metal. It has seen a 3-month highs. That's where it's trading right now. It gained 7% in the previous week, and this has been the biggest weekly gain that nickel has seen in last 7 months as well. It clearly has been an underperformer in the previous year as well, where we saw 23% of a decline come in for nickel. But for the current year now, it seems to be turning positive as we see it. If you look at the price movement, and this is what we've done in this year until now, 1st of Jan was $16,300 a ton. We did see a decline by mid of Feb to almost $15,600 as well. But currently it's trading at $17,300. So nearly $2,000 of a jump up in the month of Feb from the lows that we saw in this current month itself. Well, the positives clearly seem to be coming in from the US announcing 500 or more new sanctions now on Russia. Now, copper and aluminum are not on that list. Nickel perhaps is, and that is what has led to a lot of short covering coming in from funds. And that is what has triggered this run-up that we've seen in case of nickel prices. Apart from that, Australia also has rolled out stimulus measures and has added the nickel to a critical mineral list. That happened in the previous month as well. That continues to be a supportive factor also. We're looking at lower inventories being in Australia, and that has been supportive. Apart from that, it is about Indonesia mining quota approval that has continued to be quite slow. Even as they've taken much of the curbs off, the approval continues to come in slow, and that has been a bit of a botheration, adding premium to those prices there. The only thing that is keeping the prices in check right now is that there's an expectation that in 2024, you could see a supply surplus of 239,000 tons. But the markets also are looking at stimulus measures coming in from China, the steel production and demand on the higher side, the EV demand slightly higher as well. And nickel is a major ingredient, and that is where the support also seems to be seeping in.
All right, Manisha, thanks very much for that. So that's commodities in focus. More later. We'll take a quick commercial break here. On the other side, it's a special segment. It's the economy. My colleague Lata will get chatting with Mr. K. Srikumar, Senior Vice President and Co-Head Corporate Ratings at ICRA. Rajesh Magao is co-founder and group CEO at Make My Trip. And they talk about how the tourism industry will shape up in FY25. Stay tuned.
Welcome back. On It's the Economy, we are looking at the tourism sector. Hotel stocks have shot up by 100 to 200% in the past 1 year. EIH, for instance, East India Hotels, formerly, has surged 152%. Indian hotels, nearly 100%. And between them, Chalet and Taj, GVK, Lemon Tree, all of them, between 100 and 150%. Reason, besides the rising prosperity or the demographic dividend, there is also the newfound rise in religious or spiritual tourism spurred by the Ayodhya temple. But tourism has had its problems as well. The rise in the tax collection at soars from 5% to 20%, the poor flow of international tourism and therefore of flow of foreign tourists into India, visa problems for Indians headed to the United States, and of course geopolitical problems like Ukraine, Palestine and Maldives. So how will tourism shape up in FY25? We have two experts joining us, Srikumar, the Senior Vice President and Co-Head of Corporate Ratings at ICRA, as well as Rajesh Mago, the Co-Founder and Group CEO at Make My Trip. Gentlemen, thank you very much indeed for your time. Rajesh, let me start with you. What's the sense? What's going for tourism in the current year? We are seeing hotel stocks, shoot up about 100 to 200%. What's going for tourism this year and more importantly, FY25?
Yeah, thank you. Thank you, Lata, first of all. Good morning and thank you for having me on the show. You're absolutely right. I think what is driving this is the momentum on the demand side, coming out of first year of recovery, I would say full recovery post-COVID in fiscal year 23. This year has been, significantly driven by the demand momentum, where people are, all segments of travel have sort of come back, and not necessarily only leisure, but the business segment, the VFR, the, pilgrimage tours and so on. And that is what is sort of, I guess, driving the stocks for the hotel industry as well. In terms of 25, outlook for 25, if you look at some of the neutral reports, the third-party reports, WTTC is talking about some 7.8% growth for the next year. There are a couple of other reports which are actually talking about double-digit growth for the next year. I'm personally in the second camp. I think the momentum is going to continue, and the growth is likely to be more double-digit even in the new year. And I would say that for a couple of reasons. One, I think it's on the supply side. And as you probably know, that this year, while the demand momentum was great and the prices were high because there was some supply constraint, there were engine issues, go first issue on the air side. While on the hotel side, the supply has also been sort of expanding. A lot of the hotels have announced to add more hotels, etc. Now, the benefit of all of this is going to come in the current year, fiscal 25, as the supply improves, as we see more and more planes coming up, some of the operational issues get resolved, go first issue is behind us, and the benefit of the hotel, a lot of the hotel expansion that has been, sort of work in progress for the last couple of years is also going to play out in this year. And I would also add, besides the hotel, I would also add homestays as a category, because there's a lot of the new supplies coming into the market as well. So if you look at on the supply side, that is one big reason that I believe that the benefit of that will come in the next year, and that will drive the growth. And if you look at
Rajesh,
the demand side,
Rajesh, let me get Srikumar in as well, and I'm coming back to you with lots more questions. Srikumar, it looks like there has been a 15% rise in hotel ARRs and a 12 to 14% growth in tour operators' revenues. That's the reports coming in from both ICRA as well as Crystal showing us. But how does this compare with pre-COVID? Is this just a jump in terms of revenge growth? And therefore, what are your own forecasts? Will FY25 be as good as FY24 in terms of demand?
Good morning. Thanks for having me. To answer you, the growth is much more stable and steadier in the ongoing upcycle. Generally, tourism sector in general has seen a strong growth in the last 2 years. We are seeing growth across, hotels, airlines, and tour operators. A comparison between a pre-COVID and a post-COVID, pre-COVID, we did have a concern with regard to the, supply-related aspects driving. A lot of supply got added between the period like 2010 and 15, although there was a good demand between 2016 to 19. But the pace of growth was not quite significant. However, post-COVID, what we observed in the hospitality sector was that the recovery was strong, and this was supported by favorable demand from all segments like leisure, MICE, business travel, and spiritual travel. And the levels reached the pre-pandemic days in FY23 itself. However, the hoteliers were cautious in committing to the next phase of supply addition, and the capex was largely restricted to the completion of the already deferred projects. So the demand-supply gap kind of widened and supported this upcycle. So if we have to compare the pace of growth in the demand, obviously it is much better and much more steadier. What will also support the growth is the fact that demand-supply inequation will obviously support the demand per se, the growth per se for 1.5 year more. We expect the hotel sector to grow at 14 to 16% in the current fiscal, that is for FY24, and to high single digit 7 to 9% in 25. This is again coming on a very high base. Occupancy levels are still at decadal highs of 70-72%, which will be continuing in FY25 as well. The pan-India premium hotel IRRs, which was the peak was seen in FY 2008 at above 8,000 odd levels, that will be hit in FY25 for the industry as a whole, although some of the hotels have already crossed these all-time high levels in FY24.
Okay, I got that from your data that we are likely to reach 72%, which was a level reached only in 2008. But I'll just come back to you, Srikumar. Rajesh, there are two issues that both of you are flagging. The growth of hotel rooms is seen at 4 to 5% or 4.5 to 5% according to ICRA data. It takes a while for the capacity to catch up. So room rents, the ARRs and the charges are also at, kind of 2 decadal highs. Likewise, air travel, the capacity constraint is so severe with or without Go Air. I mean, there are airport constraints. There are so many flights cancelled out of Mumbai because of airport capacity constraints. Both hotel prices, premium hotels that is, as well as air travel are likely to remain more expensive in FY25 from what little data I have. What's your reading and, whether my numbers are right, and therefore will that impact the growth in tourism?
Yeah, no, I think your observations are not off. Specifically, if I would say more from this year's perspective. And overall supply, and I think we have to keep that in mind in India overall for branded hotels, or call it premium hotels, a total about 160,000 rooms in the entire country, which is like much less than you compare with any other country. Like you compare it with Dubai, you compare it with Singapore, you compare it with Thailand, etc. It's much less, and therefore more and more sort of commitment is coming through from the hotel industry in trying to expand it in various different models. And then there are various different models are being tried, which are not necessarily, completely greenfield projects. Maybe some of the non-branded properties are being looked at very, aggressively being, and trying to convert them into branded premium hotels with refurbishment and some commitments, and bringing in their own sort of playbook of managing the properties, etc. So I think it is only going to improve going forward. That is the first point that I would like to make. And the second, I think the interesting point that we may be missing out this whole price rise or the ARR also is that it also has the sort of impact of which is baked in of the 3 years cumulative inflation, because for the last 3 years, I mean, during 2 years COVID, no price increase that happened. And fiscal year 23, when this was the first year post-COVID recovery year, again, the prices had not really gone up. So to my mind, it's actually the cumulative impact of the inflation, which is baked in the pricing, is also being missed out. And if you sort of factor that in and then start to look at the prices, you will see that this new base that is getting established. And then on top of that, if you see, the price rise, you will not see necessarily, a very high rate of increase there. So I think it'll sort of balance out the thing. And I think it's an important point not to miss out.
I get
but
that.
I do think on the supply side, fundamentally, we do have a supply constraint in our market. And premium for sure, but if I look at mid-segment, sorry, just to complete the thought on the supply side, and the important point, the mid-segment and the point I was making even on the premium side for homestays, there is a lot more supply coming in on the second home, the villas segment, which is the premium segment, which is a very welcome addition to the premium segment of the supply as well. Like we will have, over non-hotel alternative accommodation, like, on our platform, about 125, 130,000 rooms already, all segments put together, but a lot of that chunk is also premium. So I think some of these factors
Rajesh,
are only going to equal out the supply.
Yeah. Rajesh, I'm sorry, I'm trying to pack in as much as possible. What about the issues in terms of, say Maldives is now taken a back seat? Does that eat into the overall package, or it just gets replaced by other destinations? Secondly, international travel has not quite picked up. I mean, Europe in a recession, the US visa issues are still like so lagged because of, bunched up demand of the last 3 years. So will all this be a negative, or will it actually be positive? Because, there will be revenge clearance of visas. So will all this make it better next year?
Yeah. No, I think, again, both good points. So I'll tell you about the Maldives. First, Maldives was a very, very attractive location for Indians when people were traveling. And given the demand momentum, one sort of city or one country having some kind of an issue, the consumers actually moved to the other location, the other destination. So it actually had no impact, to be honest. I mean, there was obviously a temporary dip on Maldives per se. And people, and maybe the growth rate of Maldives will get impacted, but overall growth rate is definitely not, because it's getting replaced by other destinations. And the other point on outbound is also very, very interesting. I actually think that because outbound or the international travel was one segment where the recovery was lagging. Now in this year we have almost caught up to the pre-pandemic level. And when I say we
what about
of course,
inflow,
and also the industry has caught up.
Inflow, Rajesh?
Not the inflow. I'm talking about the outbound.
Inflow hasn't picked up, is what?
Inflow hasn't. Inflow is about, I would say, in the 70s, and some inbound tour operators would say that it's sort of catching up really fast now. And we don't really focus on inbound travel, so I have sort of less up to date info on that. But outbound has caught up. Outbound has caught up, and that's only going to just go in one direction.
Got that. My apologies. I'm being rushed by my producer. Srikumar, you get just about half a minute. What's the, which is the industry that's likely to do well? Will tour operators do better? Will it be hotels? And for hotels, what is the growth expected?
I would say all the three segments will do quite well for FY25. More importantly, hotels, if we have to talk about its sustained growth, because the supply is going to catch up quite late. Airline sector as such, like, the domestic traffic as such is expected to reach a pre-COVID levels only in FY25, although the international traffic has already reached in FY23 itself. Tour operators is obviously a resultant of the growth that is catching up in hotels as well as the airline sector. So they have been supported by that, except the issues that you have rightly pointed out on the visas and also a few other headwinds that they had. But in tourism sector as such is likely to continue its momentum for FY25 in a much meaningful manner for FY25.
On that optimistic note, thank you very much, gentlemen, and thank you for speeding up the editorial that you want to present to us. We have to wrap up on Bazaar. Chartbusters coming.
Asian Paints is the biggest loser on the Nifty. Today, brokerages CLSA and Goldman Sachs have downgraded the stock post Grasim's paint business launch. CLSA lowers the target price to 24.25 rupees a share, while Goldman Sachs cuts the target to 28.25 per share.
Rain Industries falls nearly 7% on weak quarterly performance, loss expanding to over 1,000 crore rupees, while revenue falls 1.5% on a sequential basis.
Indus Tower zooms after the stock comes out of F&O ban. Brokerage Bank of America issues a buy call. The stock is up nearly 4%.
Paytm hits upper circuit as the Reserve Bank of India advises the National Payments Corporation of India to examine the company's request to become a third-party application provider for UPI payments. The stock is up closer on 5%.
Woodco climbs over 3.5%, announces its plans to sell 0.2% stake in the company for the government to meet the minimum public shareholder norms. But apparently, we also have some more news coming in on Woodco with regards to a tie-up with NBCC.
Hello and welcome to Chartbusters. I'm Raj D'Souza. Joining me as always, myself and Mangala Malu. Hey Mangalam, what's happening this morning? It appears, for starters at least, the market is looking a little bit nervous, but par for the course, I would say. What a great run we have had, right? So some kind of a pullback, I think, till the 21,950 odd level holds out. I think we're pretty much fine.
Well, 22,150 to 22,000, itself is an important support zone for the market. The only fly in the ointment is the weakness in the Nifty bank. From Friday's high itself, we've seen a near 550, 600 point correction on the Nifty bank. And in doing so, it's also fallen below the 50-day moving average today. So 46,800 thereabouts is a mark that we'll be keeping an eye out on in terms of the Nifty bank looking to reclaim that. The mid-cap index lower today with more stocks declining than the stocks advancing. It is an expiry week, start of the week. So let's see a lot of cues lined up for the next 3-4 trading sessions. Let's go across straight to then Shivangi Sarda, who's joining in with her view on the market. Shivangi, a bit of pullback is what we're seeing. Some sort of resistance for Nifty upwards of 22,350 and for the Nifty bank as it crossed that 47,200 mark. What do you think one should do with the indices and individual stocks now?
Good morning, Mangalam and Nigel. Thank you for having me. So we have seen that there has been a good 400-point recovery in the last two sessions of the last week. Today, after a soft opening, we're seeing the indexes consolidating in a very narrow range. Overall, if you look at the broader time frame, support-based buying is very strong, and the entire index looks quite positive for any small decline to be utilized for buying. Of course, softness in range-bound move cannot be ruled out. Today, India VIX is up nearly about 15.9, at levels. And also, Bank Nifty and the IT stocks both have, kind of not performed from the, start of the Monday morning. So overall, the index is likely to remain in a range. For the expiry point of view, of course, we are going to, witness swings and volatility. But overall, bias is towards the positive side. So we could expect 22,350 on the upside, while 22,000 levels would be immediate make or break zones for the index. Talking about Bank Nifty, we have seen that underperformance is clearly continuing over here. And some of the private banks have, now, given up after taking a little bit of a support. But now we haven't seen much of a follow-up in these counters. So overall, Bank Nifty is likely to remain in a range, and we could look at 46,250 as a crucial support zone for an upside move towards 47,250 levels. This is the range coming out for Bank Nifty, but clearly the conviction is more on the Nifty side. With stable put-call ratio and the volatility coming down, we could expect a good up move over here. Now, stock-specific action, if we have to talk about, first pick on my radar is L&T. We have seen that there has been a quite good buying interest over here, 50% open interest addition so far in this series in the February month. Stock has come out of its consolidation of the last 18 sessions and now crossing its 50 daily exponential moving average. So this stock is looking quite positive, and of course, with the entire theme in action, this stock is going to get a tailwind from the sector-specific action as well. So 3620 is the next targets that we are looking at for this stock, with a support of 3,400 levels. Now, the second pick on radar is IRCTC. There has been a lot of action in the travel and tourism space. Even Indigo, for that matter, has driven quite well. Even the hotel space is looking quite well. But my preferred pick over here is IRCTC, as it's come out of its consolidation of the last 22 sessions, and it has surpassed its previous hurdle of 968 zones. So this stock is looking quite positive. It has taken a support at a retracement level of the recent swing high of nearly about 875 levels. So stock is quite positive. It's taken support near its key exponential moving average as well. In this series, we have seen 20% open interest addition in the long side. So overall, stock is quite positive, and we could look out for buying opportunity. The next targets are 1030 levels over here with a support of 965.
Thanks a lot for that, Shivangi. Always good seeing you in for your call on the index as well as on the individual trading strategies. For the time being, though, we'll shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta of moneycontrol.com joins us to tell about stock that he's tracking closely. Jitendra?
Hi, thanks. Cochin Shipyard reported a good set of numbers in Q3 FY24, recording almost 64% growth in revenue. Few of its projects had faced delays due to logistics hurdles and other issues in the first half of FY24. However, in Q3, execution picked up. The ship repair division witnessed a 70% year-on-year revenue growth fueled by strong orders. Moreover, higher scale and better revenue mix resulted in a strong 622 basis points improvement in EBITDA margins to 29%, which resulted in robust 121% year-on-year growth in net profit. The company has guided 12 to 15% year-on-year growth in revenue for the fiscal year ended FY25. It also indicated to maintain strong sustainable operating margins in the region of around 18 to 19%, as against 15 to 16% earlier. In terms of visibility, the company has good revenue visibility backed by strong orders in hand, close to rupees 22,900 crore orders, which are about 8 to 9 times its annual revenue. Its stock has surged from around rupees 216 in March 2023 to currently it is trading at 830 levels, while valuation at 20 times its fiscal 26 estimated earnings are on a higher side. Stock should do reasonably well considering strong execution, earnings visibility, and of course orders in hand.
All right, Jitendra, thanks a lot for that. With that, we'll simply a short break. On the other side, we have the management of Kirloskar Ferris. Mr. Gumaste, who's the managing director, joins in to discuss the business of the company going forward.